volatility going down. In other words, this is a risk-on day where people are moving out of cash into investable assets, whether those are stocks or bonds, large cap, small cap, you name it, they're getting a buyer showing up today. All right, let's go ahead and take a look at our first visual for today, and that's going to be this one here, our relative rotation graphs and its respective keys, so we can understand it just a little bit. Looks like we've got space for that down here today. As we do here, folks, these four quadrants represent those areas that are either leading the market on a relative performance basis, weakening in their relative performance, currently lagging, anything here in the red, or currently improving. And in fact, except for the tail of IXC, which we note is the communication services sector, there is nothing in the improving right now, but rather we either have leaders, which is IXC, or we have either weakening or lagging the rest of the market. So IXC clearly finding its way into a leading category. Maybe we'll get a chance to take a glance at XLC's chart, the ETF following this index, and you can see the astounding outperformance that's shown up over the course of the last couple of weeks. A very positive looking chart there for IXC. But nonetheless, the sector that we are focused in on today is this one right here. It's been hiding in this kind of neutral to slightly negative, slightly improving area for the last several weeks, maybe even a month, while we've been diving through these. But it's time for it to get the spotlight. This is the one we are looking at. Other notable changes, we did see some weakness showing up for IXT technology. This one is, folks, a database that comes as of the closing prices yesterday. I know it says June 3rd up here, but the most recent dot for any one of these is based off of yesterday's price. So this represents yesterday's weakness. It doesn't include the fact that it's got a 1.5% positive today. So perhaps we'll see a little bit of a reversal back into that leading, but nonetheless has been weakening. Utilities dropped substantially on its relative outperformance, coming down here, still weakening. It's on the right-hand side, so you'd have to say it still is doing better than some, but nonetheless losing much of its prior lead. Often we see things move in this kind of elliptical clockwise motion like we're seeing here for real estate, which also had a monstrous move downwards from leader down here now to clear laggard. Let's take a closer look at a few of those ideas as we dive in. The next spot we're going to look at is this one right here. Our sector performance updates, where we've got our closing value for the month of May. This is what all of May performance ended up looking like. You can see the outperformance from information technology, notching 10% for the month of May alone. That brought the S&P 500 up to positive 5% for the month. Remember, this is just for the month of May. Whereas we have communication services up about 7% and utilities notching about 8.5% positive. The sole negative here was energy, giving up some of its positivity. Now, the sole negative sector for the month of May. If we look at this and compare instead our month-to-date view, here we are, our month-to-date loading. So this is just the first few trading days of June, and where we sit, this is as of first thing this morning. We see the S&P still positive, but less than 1%. Energy continuing its slide from last month, now 4% negative. That's much more than we saw in the month of May. It was only down about 2% for the month of May. Information technology still strong here at 3%. Communication services just less than 2%. But we do notice that for the month, we do have 1, 2, 3, 4, 5, almost half of the sectors negative. though it's worth noting that each of these are amongst the smaller of them, with the exception of financials. Financials is the second largest sector in the S&P 500, at least based on small fluctuations one way or another. Financials a large piece of the puzzle. Information technology, the largest one, positive, definitely weighs in and brings that S&P 500 positive. So we can thank the NVIDIAs and many others for pulling that market positive over the course of the start of June. And we'll see what else is going on here in just a moment. Knowing this to be kind of our backdrop and where we've been seeing the positive performance, well, it's time for us to go ahead and swing through now and take a look at the different heat maps that I create for us each and every week. This one is 1 week's worth of performance, and we can see that across the S&P 500, the things that have done absolutely the most positive are actually hidden over here to the right-hand side. We see that diversified telecommunications, specifically that's Verizon and AT&T, notching 6% positive over the course of the last week alone. T-Mobile joining that same party, so your wireless providers certainly doing very well over the course of the last week. Boeing also recovered and notched a 7% return. A couple other pieces in here, real estate getting a 3% positive over the course of the last week. But if we dive in and think specifically about our area of focus today, healthcare, that's this one here. There were some positives, certainly quite a few of them. We see, for example, ELV up 4%, 4%, 4%. Not a bad week for many of these as well. BDX making 5.2%. And Biogen up 7% hidden over here to the side. So there were some positive parts for the last week for healthcare alone. And if we zoom out a little bit and think about the last 4 weeks worth of performance, so now 1 month's worth of performance, well, now we see a very different viewpoint in that information technology over the last month has been the dramatic outperformer, 7.9% positive as a sector, and specifically much of that coming from semiconductors, where we got 17.9% as an industry, largely on the backs of NVIDIA, continued growth, especially post its earnings at 28.6% positive. Quite a few big performers there in the information technology sector. Healthcare did not do poorly either, though. LLY, which is Eli Lilly, up 7%, Vertex up 15.8%, Moderna up 20%. We'll look at this chart at the end of the session if time permits. But on the 1 month view, there is quite a few that found their way negative. 7.8% down here for symbol A. CNC off 7.6%, MOH down 12%, Dexcom off 10%, VRTS off 10%. So while we had a few standout performances by some of the largest pieces in the healthcare sector, nonetheless, there were some weaknesses showing up. So our grand total for the month, about 2% positive, and we'll take a look at what that means on our overall chart over the course of the latter end of this session. So those are all resources I've shared with you each and every week in the past, and now I'll specifically ask you to please share your thoughts with me on the upcoming resources. These ones are coming from FactSet, a third-party database that is a paid resource that costs a substantial sum. And so we had to twist some arms to get a trial version of this data. But we think that the information is extremely valuable and something we would love to be able to share with you on a regular basis. If you find it valuable, please let me know in the comments. If you find it confusing, you think it's just not quite as good as what we've been sharing in the past, equally valid feedback. Just let us know your thoughts. The next several slides I'll be showing you are coming straight from the FactSet database, as you can see down here at the bottom. This one is talking about the revenue breakdown based on where and how that revenue comes. Many of you have heard, I imagine, that if you invest in large companies in the United States, you get a substantial industrial and worldwide international exposure. And so you don't necessarily need to invest directly in foreign markets. Some In some places, that is absolutely true. But here, when we look at the healthcare sector, you notice that 65% of total revenues are derived here domestically. And the next largest locale is from mainland China at 4.5%. And the others are really these tiny little sums, almost all income coming from the United States alone. So if you are one who says, I don't need to worry about international investing, but your portfolio is skewed largely towards healthcare, you might need to consider that perhaps there is some reason for you to search out additional diversification, as the vast majority of revenues for healthcare companies are coming right here from the United States. If we look at it over the course of the regions, even including your Mexico's, your South America, Canada, all together in grand total, the Americas, revenue for 2024, which is what we were looking at here above, is 69%. And remember, we were at 65% for the US alone. So all told, this is almost entirely based on the United States. There is 15% coming from Europe, so you do have a small part from other developed nations, and if we wanted to look at that, that's how you can divide it up here at developed nations versus emerging economies, or even frontier, very small economies. Then that's what you could look into. But the short story is that for healthcare especially, almost all of the income for many of these is coming right here from the good old US of A. If that's not something you are accounting for, it may be worth doing so. This next one is just looking at where the revenues come from on a sector basis. We're looking at the companies that are the healthcare sector, but then we recognize that not all companies generate all of their income from one place in the market. For example, Amazon sells much of its products online, and that's what we often think of with Amazon.com. But have you considered that Amazon derives a decent portion of its income from other things? For example, from the AWS platform, Amazon Web Services, where they provide data, storage, and analytics available to the world as a separate product entirely unrelated to Amazon.com retail trading. Well, this is trying to understand a little bit more about that for companies within healthcare. It turns out that 97% of all revenue for healthcare companies comes from their healthcare business. And the largest piece of that comes from healthcare services, and the largest piece of that, healthcare support services and health plan providers. We'll see how this differs as we look at some of the other sectors in coming weeks. But healthcare essentially is entirely focused on this sector and this sector alone. Now, the next piece we typically look at is diving in and looking at seasonality. I've shown you my own custom-made seasonality graphs that look at how performance is measured. This is a different look at the same idea. I'm only able to provide you that seasonality data over the course of the last decade, which, if you've looked at a chart of the last decade, know that there's some positive skew in that data, since there were, at least until 2020, very few bearish movements in that market. It looks a little better with now 2020 and 2022, each of which had some bearish pullbacks or corrections or even full-on bear markets showing up there. But nonetheless, this is going back now to 2004, 20 years worth of data, and we're looking instead at the monthly performance. The one that I typically show you for seasonality is what we would call a detrended seasonality analysis. This one is not. This one does not eliminate the trend. Instead, it's simply looking at month-by-month performance over the course of the time frame and has colored it in based on positive or negative. So as we take a look, our averages are listed here across the top, where we have for the month of January, for example, a positive 0.3% average result. And our January in 2024, 2.8% positive, remarkably positive compared to the average. But as we dive deeper and look at what made this average, we can see -7, -7, -5% showing up. and contrasted with +7, +6.5, +4.5. Maybe our 2.8%, though it was above the average, wasn't necessarily an extremely positive result, but rather it was an approximately average result, not extreme in the movements that we have seen. We also notice over here later in the year, we have negative expectations for both August and September's in terms of the average. But specifically September, we note that over the course of the last 5 years in a row, we've had negative performance for the month of September, whereas the last 4 years in a row for July has been a positive month. So far in June, this going off of yesterday's closing values, we were positive for healthcare at 0.6%, which was approximately, 0.7% this time versus the average at 0.6%, right in line with that averaged value. But there have been as high as 6.5% positive, as negative as 4.5%. But the reality is that positive so far for June is already where we're headed. If we continue in that vein, we may see some continued positivity through the summer if averages hold out. Let me know if you like this version of seasonality versus what we've looked at in the past and where we can see that information showing up. Clearly, September struggling, especially in recent years. And looking back, there is but one vastly positive month, but it was one of the most positive out of any of these that we have seen. And that actually came back here in 2010, shortly after a pullback in August. Then we see a strong recovery in September, 8.5%. The only one that outstrips it are a couple here in November, October, and here in April. But nonetheless, September is a typically weak month overall. That's our seasonality look here from FactSet. Next, we're going to look at one of my favorite resources pulled from FactSet, and this is going to be our long-term cumulative results by sector. Sector-focused research is a little bit difficult for the long-term viewpoint. Using Fidelity resources alone. And so this one relies on all the way back. You'll notice our graph goes to the early 90s and even into 1989. So a long way back, and we can see our annual compound growth rate. Sometimes this is called the CAGR, the compound annual growth rate, is measured out for the healthcare and also compared against the S&P 500 over the last 35 years or so. While we have access to this data, healthcare has notched 11.6%, 11.7 compared to the S&P 500 at 10.4. Either of these would have made you rather wealthy if you started with a investment in that beginning time frame in the 1990s and held until present. That's the cumulative difference. But when we look at that 1.5%, 1.33% difference, we might have been startled to find that our cumulative return, our grand total change in wealth, would have been 4,500%. In other words, 45 times your initial value is what you would hold currently in your account if you invested in healthcare. Whereas in the S&P 500, 30 times your original investment. Substantial improvement on either scope, but the fact that you had that slight improvement on the annual growth rate for healthcare amounts to a dramatic difference in holistic return as we look to the bottom. I'm focused on this right-hand couple of columns because this is the total return, including reinvestment of dividends, as opposed to over here, the price change, which only looks at the index alone, not their respective dividends and assuming they are reinvested over time. Total return, typically a better view when we're looking at long-term history. So that's if you happen to have invested in healthcare. It outperformed the S&P 500 by a substantial margin over the course of the last 35 years. But that's not been the case in the most recent few years. For example, here's a look at just the last 5 years, going back now to just 2019, during which now it's our green line that outperforms. This is the S&P 500. S&P 500 getting a 14.8% compound annual growth rate over the last few years when we look at its total return, and in healthcare, matching its long-term history at 11.7%. As a result, it's been a preference towards investing in the S&P 500 in the last 5 years. That's remained true over the course of the last couple years, as well as we zoom in even further. But just a quick idea on the relative performance between these over time. I've got a couple other graphs to show us really quickly. This one is looking at healthcare specifically, but now we are diving into the fundamentals behind the healthcare sector. Specifically, we are looking at its price to earnings ratio, taking its current price and dividing it by the earnings per share to understand how much am I paying for the earnings that exist. LTM represents the last 12 months, so looking backwards 1 year at the earnings that have been brought in. NTM, next 12 months, so looking at forward estimates of earnings and how do they compare. If we look at the last 12 months, we see that it's at a 30 times multiple, and over the course of the last 20 years that this data is displaying for us, we are seeing the highest multiple for healthcare that we have seen in the last 20 years. In other words, you're paying a lot for current earnings looking at healthcare. But that might be okay if there is substantial growth expected in the sector and that substantial growth appears, it actually materializes as we move into the future. That's why we want to look at this next 12 months as well. And we do notice that the actual value is substantially different. There is growth projected for the healthcare sector over the course of the next year, bringing it down to now just a 19 times multiple. But even that 19 times multiple, as we look back over the last 20 years, does bring us in to a state where we are viewing the highest multiple, the most expensive that the sector has been on a forward basis, again, over the course of that same 20 years. It started out right here at about 18, peaked at about 17 and a half, 17 and a half, 17 and a half. Right now, we've launched ourselves higher in 2024 on the backs of higher prices, not yet being justified by the higher earnings growth. In other words, the price is growing faster than those earnings are projected to grow looking forward. So that's a lot of information to swallow all at once. I've got one other chart to glance at here. This one is the overall returns and earnings for the company. One of my favorite resources we're getting from FactSet. This is telling us how many of the companies outperformed on their earnings per share, meaning they surprised the market with a positive result, more positive than was expected. This result, 91% of the time, 91% of companies within healthcare equipment and services were reporting positively. 85% within the pharmaceuticals, biotechnologies, and life sciences. So substantially positive report for the most recent quarter for healthcare, better than expected in the vast majority and far more than the average for the S&P 500, though the S&P notched 80% positive surprise. That was a lot of resources and leaves us just a couple minutes to dive in and take a look at the last couple things which I wanted to show you, which is specifically diving back into the charts to see where we are looking from here. So I'm going to go ahead and pull that up. We do also have our sector screener that I typically dive through, but I'm going to belay that one today to instead look at some of the most interesting charts in the sector. XLV, I'll show you just briefly, represents a pretty positive chart overall, but it's not unlike that of the S&P 500. I have it pulled up on this one with the moving averages to show how important this most recent rally. We're closing in on the 6th day in a row of green candles. That was enough to bring us back above a negative 50-day simple moving average, back above the 5, then back above the 20. All of those are now moving back in the right direction, recovering substantially. This is an important moment for the healthcare sector. June shaping up pretty positively. But it was pointed out in one of your comments here, even before the session opened, that we've got kind of this triangle showing up on the chart, and that a breakout in one direction or another could be indicative of something important for the economy. And not only that this shows up in the healthcare sector, but across several other sectors as well. It certainly is the case that if we see the market move higher, it will be on the basis of continued aspirations for a positive economy over the course of the next coming 3, 6, and 9 months. The longer into the future we look, the less reliability perhaps we can use. But nonetheless, positive is positive, and positive does as positive does. We saw a recovery on its most recent trajectory up, far above this one that saved the market last time around. That's starting this positive slope here on the lower end. But I specifically wanted to take a look at the charts for a couple of these. Bristol Myers Squibb, not nearly as positive over the course of the last year or even the last couple months, representing a change from $66 per share now down to $40, losing a third of its value. And you can see why, if I expand this up to see its price to earnings ratio, that same metric we were looking at on the charts from FactSet for the sector, it was in the positives and even coming down here at relatively low valuations. But its most recent earnings report said we didn't earn money, we lost money this time. The market had that right in terms of decreasing valuation over time, but even so was surprised by the negative result and continued to swing down here. Bristol Myers Squibb substantially off here on its year-to-date and continued growth in terms of earnings. This is one of the large players in that pharmaceuticals world. Bristol Myers Squibb off pretty substantially. That's a negative chart as we take a look at it. Negative trends all over. Gilead Life Sciences also showing up here with attempts to move higher, unfortunately failing, and the last 3 months, substantially negative trend. The attempt to rally, then flatten out here in late May, unfortunately kicked back to the curb and right on down. We're moving in a negative direction. Here we see a different directional move on its price to earnings ratio, but this is the curious thing about a ratio like the price to earnings. If we have decreasing earnings, that would lead us to a very high multiple. This launched higher. But if it happens to decrease far enough that instead our earnings flip to negative, well, that's where instead it went down like we saw in Bristol Myers Squibb. So in both cases, we saw a decrease in earnings, but for BMY, unfortunately, that resulted in a negative earnings, in other words, a loss for the quarter, and that's why we saw it swing to that opposite end. But nonetheless, trading at 170 times past historical earnings, not good news for Gilead Life Sciences. If you're an investor here, you're doing so on the basis of a substantial change in its most recent technical levels, looking at the chart, but also needing a change in the fundamentals to start proving that they are worth the millions and billions of dollars that their current market capitalization represents. Finally, a quick look at one last chart, even though we're a little past time. This one, mRNA, Moderna, a very positive chart in its current directions. It's up greater than 50% over the course of the last few months since October of last year, coming from 60, now trading at 150. That's 2.5 times its previous value. Substantial price increase. If you happen to have been investor since then, kudos to you. But even those of you who are waiting instead for it to break above this decreasing trend line that I've got drawn in, saw some great growth from 110 all the way up to 150. That's still about a 30 or 40% return, and that coming just over the course of the last month. Substantial movements for Moderna, but surprisingly, its price to earnings ratio has some of the same concerns. Specifically, it has been living in the negative price to earnings ratio, in other words, losing money quarter over quarter over quarter. But this goes all the way back till November of last year. That's a long time for the company to not generate positive returns. You'd want to dive deeper into this report to find out why it is that the market seems to think this is okay and in fact worth doubling the price even on a loss projected over the course of the last year or so. Folks, we are past time. I request, please let me know your feedback. Did you like this style, or did you prefer what we've done previously as we looked at some of this research? We've got a lot of data available for you. Your feedback is important to me in how I prepare and present this information every week. This was healthcare, all about it. I'll be sticking around to read your comments, and from now till when we close out this session, I will exclusively be answering your questions. So thank you very much. I'll go ahead and address any questions I can currently. Russell wondering, the relative rotation is relatable to each other or to the S&P 500? It is relative to each other, but since each of those represents as a whole the S&P 500, it ends up being relative to the S&P 500. Great question, Russell, but it is relative to each other. The only reason we consider it relative to the S&P 500 is because all of those are as a whole the S&P 500. And you also ask about sector performance on the chart. Would it be possible to out based on their market capitalization? I would love it if I could show you this chart with the widths based upon their market capitalization. Excel does not have a function to be able to do this and make it as repeatable as I need it to be. So unfortunately, that's not something I have done currently. There are some amazing resources that are out there that would allow me to do so. However, they would not allow me to update the chart on a regular basis. So Tableau is the one I would prefer to be able to do this, and that's not something available to me here on the work computer. So thanks, Russell. Great suggestion. Let's see. NG wondering if the healthcare sector is because they're overcharging us. Certainly possible. I won't speak to whether or not that's the case, but certainly there is concerns there, but plenty of profits showing up for the sector. Okay. Bill, thank you for the feedback. Tom, let's see. Great question. Sorry if I didn't make that clear. When we were looking at this chart, actually all of the ones from FactSet, Tom, this was exclusively for the healthcare sector alone. Great question, and thank you for asking. All the things that I showed you for FactSet were for the healthcare sector specifically, and that's where we should have been. A couple of you really liking that new seasonality version, but I saw at least one that did not. Okay, maybe we'll integrate a kind of combination of the two then. Kim, yes, there are ETFs that track the healthcare sector. Fidelity specifically has some, and also the sector spiders are the most widely traded. XLV is the one that we demonstrated there at the end of class as one of the most widely traded within the healthcare sector, but there are many that exist. If you wanted to find ETFs that trade in that sector, my recommendation would be to go to the news and research, come down here to ETFs, and then you can do the ETF screener and look for those that are in the healthcare sector. Then you can choose based on whatever criteria is most important to you on that basis. The fact that it happens to be or not be sponsored by Fidelity shouldn't be the defining factor, though the sponsor is an important aspect of it. Let's see. Okay. All right. Excellent. Cindy, I have not yet decided what sector will be next for us for next week. Probably materials, but it certainly is up in the air. It depends on what's most interesting at that time, but materials is the one that has been the longest since we reviewed. So probably materials, unless there's something remarkably interesting that we need to adjust along the way. I think I got through the majority of questions, but there are many here on in the hopper. So if I missed yours, I apologize. Thank you so much for the feedback. I'll stick around and just read through these and make sure I understand best how we can involve these. I will do my best to kind of meet the most requested versions of what has been requested. Thank you so much for joining in and letting us know your feedback. I appreciate all of you. Alan mentioning it was difficult to get in. Did anybody else have trouble signing in through Zoom today? Thanks for letting me know. If so, we'll make sure we look into what happened there. But thank you so much, folks. I'll go ahead and close things out. I look forward to seeing you back here very soon. Until then, thank you for joining with me. It's been Jake from Jake Talk Sectors. Take care.